Welcome to Market Catalyst. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, U.S. stocks hitting record highs as Nvidia lifts the market. We'll bring you the why behind the high. Plus, we'll dig into the latest inflation report and whether the Fed can move forward with rate cuts. Plus, earnings season shifting into full swing as big banks kick off reporting. All that and more coming up on Market Catalysts. First, let's get a check of the markets here. We have the S&P 500 pushing ahead and the NASDAQ as well, particularly getting a lift from Nvidia here. This morning, we did get the consumer price index coming in largely in line with estimates month over month. Core inflation actually a little bit more benign, milder than economists on average had estimated. And so now the attention will turn back to the Federal Reserve going forward to see when we're going to see more tariff increases showing up in these numbers, and then what the Fed will do as a result. Let's also get a check on the bond market on the back of that economic read here. Interesting to see the long end of the curve going very slightly lower, although really you could call all of it very little change with the 10-year yield at 4.43%. Nvidia shares are jumping today, eyeing a fresh record high and giving the NASDAQ a bit of a boost. The chipmaker saying it expects to resume sales of its H20 chips in China just days after CEO Jensen Huang met with President Trump. Joining me now on this is Antoine Schiebon, a technology infrastructure analyst at New Street Research. Antoine, thank you so much for being here. So how significant is this for Nvidia? And I should mention, they haven't gotten the full go-ahead. They say they're going to they will get these licenses approved to sell these chips once again. So how much of a positive is this for Nvidia?
Yes, hi Julie, thanks for having me. Yes, I mean, during a recent visit to Beijing, Jensen, confirmed that they had the plan to restart shipping the shipments of H20 to Chinese customers. And they don't have the full go-ahead, but they do have the assurance, that the export licenses will be granted again. And they are very optimistic. They expect deliveries to begin shortly. Just to put a bit of context, the H20 ban was a 2.5 billion headwind to revenues in the first quarter, and Nvidia expects another 8 billion in the second quarter. So that's more than 10 billion, that Nvidia, didn't expect to recognize because of the ban, and that they now see as an opportunity again. And if you put even more context, like looking backwards, China has been historically as much as 20 to 25% of Nvidia's data center business. It came down, like with the H20 ban, it came down to zero, more recently, and now they do expect China to become an opportunity again. And we don't expect, China to become 20 to 25% again over the long run, because China is now working, on its own chips. Huawei is developing the Ascend, but we do expect, maybe levels similar to prior to the H20 ban, maybe in the 10 to 15% region.
Yeah, I was going to ask about that, sort of where they get back to. I mean, in addition to the H20, the company has also now developed another chip called the RTX Pro GPU that they say is compliant in the China market. Does that make up some portion of that revenue there? What role does that chip play?
I mean, it's just Nvidia, innovating and, letting some of that innovation flow through to the Chinese market. China is not standing still. They're also innovating. They're bringing new chips to market. Of course, they're lagging behind Nvidia. They don't have Nvidia's ecosystem either to make the adoption of their chips as easy, as flawless as adopting an Nvidia GPU. But they're still innovating, and so Nvidia cannot stand still. They have to, respect the export license, but they can still bring a new generation to market. And clearly, like the U.S. administration's authorization, I mean, at least showing signs of authorizing to ship the chips again, is a sign that Nvidia has an open conversation with them, and that they can keep innovating and remain somewhat competitive. At the end of the day, it's striking the right balance between not completely losing the opportunity and not allowing China to accelerate too much, its competitiveness in AI. So it's a very thin balance that they have to strike.
Antoine, Nvidia shares are at a record again today. As we know, it broke that $4 trillion market cap. Is there anything that will stop Nvidia from continuing to move higher?
I don't think there's like a hard stop around the corner, I think, there are some very strong signals in terms of demand. You hear Altman talk about its GPUs melting. You have already some hyperscalers who are giving strong signs around next year, growth continuing into next year. The roadmap of hyperscalers of getting to millions of XPUs in their largest clusters, in their frontier clusters on a 2027 horizon. You have Broadcom guiding next year already. You have TSMC, who's like putting out all the wafers to make these XPUs, who's guiding until the end of the decade, very strong growth, and that's consistent with the peak being like clearly still further away. So I mean, yeah, on all areas, I don't see anything stopping them down. Now, don't get me wrong, there might be like an investment cycle. We might take a bit of time to get to the next peak, but clearly the hyperscalers and the global economy is getting replatformed, and there is plenty of headroom for capex to increase further, for the capital intensity of the global economy to increase further, and that will fuel very strong investments in XPUs and Nvidia in particular.
I mean, it's interesting, Antoine. At one point, we were having the discussion around Nvidia, meaning the analyst community and folks who watch the stock, about whether we were going to see a trade down effect at some point, right? What were there other chips that could do inference rather than, the view being that Nvidia is best for training, although certainly Jensen Huang has made the argument that it's also good for inference, but that at some point we were going to see clients and customers maybe migrate to some cheaper chips. I haven't heard that discussion as much recently. Is that still a concern?
It's always there. That concern is always there. It doesn't go away. But I don't know if you follow the news flow, around Microsoft, for example, struggling in ramping its own ASIC, and Microsoft is working with Marvell, for example. That also impacted Marvell stock. I mean, we do expect ASICs, like custom silicon, developed by like a handful of hyperscalers, and say at the maximum you have 10 customers in the world who can have the scale to get there. We don't expect all of them to succeed. It's very hard. It's very hard for so many reasons. It's hard from like making a chip that's flexible, making a chip that can easily be used by your developers. Anyone can put out a chip. I mean, not anyone, but many people can put out a chip that's very, very good on paper, that has very, very good performance on paper. The key challenge is to be able to make a good use of that chip. And making good use of that chip, that's exactly NVIDIA's know-how. Being able to optimize workloads, being able to learn from all the experience that it has, its very large installed base, to ensure that all its customers can really fully utilize those chips, to shorten development cycles, to allow enterprises to quickly bring like new workloads to market. That has a lot of value. And that's where ASICs are going to struggle. Of course, you're going to have other companies. We know that Google is already there. For example, they have the TPU. They're at their fifth or sixth generation by now. They've been doing that for more than 10 years, and they still buy GPUs. So it's not going to represent, in my view, like a material headwind to NVIDIA. Both are going to coexist.
Antoine, good to see you. Thanks so much.
Thank you so much for having me.
Coming up, we'll get a read on the latest economic data and what it means for the Fed. That's next on Market Catalysts. Inflation's starting to show the first real signs of tariff-driven consumer price increases. Headline June CPI rising 2.7% year over year. That was an acceleration from 2.4% in May's data. And prices are expected to rise further from here. Still, President Trump continues to pressure the Fed to cut rates, writing in a post on Truth Social, "Consumer prices low, bring down the Fed rate now." Joining me now, Eric Winograd, AllianceBernstein chief economist, and John Hilsenrath, Yahoo Finance contributor and StoneX senior advisor. He also reiterated his call that the Fed should cut rates by 3 points, the president did in response to this data. Of course, we should mention the month-over-month core prices did come in a little milder than expected. Eric, how are you thinking about the state of inflation right now and kind of where we are versus where we might be going?
So I think the state of inflation right now is uncertain. If you look at the underlying inflation dynamics, they look pretty benign. The president and the administration have a point. The primary driver of inflation over the last few years has been shelter prices. Those are decelerating in a way that's consistent with hitting the Fed's target. The problem is that that's not the only thing that matters. We don't know what the impact of tariffs is going to be, and we're starting to see some signs that that could push prices up. And so I think we're sort of in stasis in a way. The underlying looks okay, the overlay doesn't look as encouraging, and it's not clear what you're supposed to do as a central bank in that situation.
What are the signs that we're starting to see that tariffs might be having a little bit of an effect?
So just as an example, in this month's print, we saw durable goods prices move into positive territory year over year for the first time since 2022. If you screen out used cars, for another example, goods prices rose by about 0.5 percentage point. Again, a rate that's beyond what we have seen. So I wouldn't say that we're seeing a massive runaway sort of acceleration in inflation, but we are starting to see these early signs that tariffs are going to matter over time.
John, as somebody who covered the Federal Reserve for a long time, obviously the pressure that's on the Fed right now is unusual and unusually public. We talked a little bit about this yesterday. How do you think that not just Jay Powell, but the rest of the Fed members are sort of processing what's going on in the outside world?
I think Jay Powell is trying to keep his eye on the ball. And for him, the ball is the inflation rate and getting the inflation rate to the Fed's 2% target. It's a little bit above the Fed's 2% target. Frankly, I think the political posturing is going to be a bigger issue for the Fed next year than it is this year, when there's a new Fed chairman in there who may have made some commitment to the president to cut rates aggressively. Ironically, if Powell gives the president what he wants and cuts rates now, then the next Fed chairman is going to have less room to cut rates and give the president what he wants next year. I want to say one other thing about the inflation story. Frankly, I think there's too much attention right now on the tariff effects and not enough attention on just the underlying rate of inflation. The Fed's goal is 2% inflation. So let's say there's been very little effect of tariffs so far. The inflation rate is still a little bit above the Fed's 2% target. And what we saw with the number today is consistent with that story. We had 4 straight months of readings that were low of 0.2 or below. And this month we got a reading of 0.3, which is consistent with like a 3 or 4% inflation rate. I like to look at the price of a haircut. I think that tells you something about the rate of domestic inflation. The biggest inputs in the rate of a haircut are labor and rent. And that's going at a rate of 3.5 to 4%. That's got nothing to do with tariffs. It's got nothing to do with the exchange rate. It's the domestic economy. And I think the Fed doesn't have inflation at the 2% goal. It's really, in my mind, they're going to find it hard to justify cutting rates a lot in the months ahead if they're hovering a little bit above the 2% rate objective, inflation rate objective, regardless of what tariffs are doing.
Breaking news, we got to make the Hills and Wrath haircut index. Heard it here first, folks. That's what we're going to be introducing to the economic world.
You can see the chart on my LinkedIn page. I just posted
I need to spend more time on LinkedIn. Eric, is part of this that the Fed needs to bring down that inflation target? Or I should say bring up that inflation target, excuse me. Is that part of the issue here?
So look, the Fed can't change the inflation target. It's no good changing a target when it's convenient to do so, because then you lose credibility. I think it's reasonable to argue that the target should have been set higher when they originally set it, but it's a little bit late to do that now. It's just you can't change it midstream without risking your credibility. I disagree with John to a certain degree, though. I don't think the Fed has to wait. In fact, I think it would be a mistake for the Fed to wait until inflation is all the way back to target before they contemplate cutting rates.
But what's the argument for cutting rates sooner?
So the argument for cutting rates sooner is that inflation tends to lag the economic cycle, right? If you wait until it's all the way back to target, you have almost certainly waited for the economy to weaken too much. So I agree, you need to see downward momentum, and I think that the Fed agrees with that too. But take the counterfactual. The Fed did cut rates last year. If they hadn't, rates would be quite significantly higher now, and I don't know that anybody really thinks that would be appropriate for the economic circumstance. The Fed, much as they are data-driven, also needs to try to be forward-looking, and when you see indicators that suggest inflation is going to come down, you want to respond to that. I'm pretty confident that were it not for the tariff overlay, the Fed would be cutting rates right now. I think the underlying dynamics are consistent with the gradual progress toward that target. It is the uncertainty that's restraining them. And we can debate whether that's appropriate policy or not. Within the Fed, there's a debate. If you think about the dot plot right now, roughly half the committee doesn't think they're going to cut rates at all this year, and another half of it thinks they're going to cut rates at least twice. So these are reasonable disagreements to have. But unfortunately, from a market perspective, this is a disagreement that's going to persist because the data aren't giving us a clear answer.
John, what do you think of that view?
Look, can I take the bait on this debate? And I think you answered my response, which was that the Fed has already cut interest rates. They cut interest rates by a full percentage point last year. They did some of those rate cuts before the election and some of those rate cuts after the election. So some of them may have benefited Biden and some of them benefited Trump, but they got the short-term rate down a full percentage point, and now they're waiting to see if there's follow-through and if inflation is continuing to recede. So is it continuing to recede? I think another way of looking at this is I just don't think the neutral rate, the rate at which the economy is producing either less inflation or more inflation, is where the Fed puts it. The Fed has said it's around 3%. I think it's closer to 4%. The Fed funds rate is a little over 4%. I just don't think they've got a lot of room to cut rates much more unless they want to create more inflation. And that's the risk they're going to run. And frankly, if the president gets what he wants and the Fed cuts rates by 3 percentage points, we're going to get a lot more inflation.
Eric, I want to get your view. I want to put a pin in the sort of inflation targeting conversation and ask about the personnel side of this, because I think that's really important right now, too. The Washington Post reporting yesterday that Kevin Hassett is sort of rising in the ranks in terms of a potential contender at the top of the Federal Reserve. A lot of people have been saying to us, the Federal Reserve is not one person, it's a committee, right? It's a board of governors. So, but nonetheless, if you get someone who is effectively closely allied with the president, what effect do you think that's going to have in the markets?
So I think the concern in the markets is that if you get someone closely associated with the president, that the decisions made on monetary policy won't be made for economic reasons. And that is a problem, at least a potential problem. We have seen the impact of central banks not being independent globally repeatedly, and it's not a pretty picture. It's not something that I think anybody would want to see repeated here. It is true that the FOMC is a committee. I think it is improbable that if a new Fed chair came in, that the direction of monetary policy would swing immediately. I think it's improbable that any of the candidates under consideration, Kevin Hassett, Kevin Warsh, any other Kevin you want to pick, would come in and immediately cut rates by 3%, simply because even if they wanted to, the committee wouldn't go along with them. That said, the committee has historically been very deferential to the Fed chair, and I think it's reasonable to think that the new chair, as long as they are making a reasonable argument, will have the committee's support in doing that. But again, the key emphasis there is it has to be a reasonable argument based on the economics. And if you bring someone in who argues that rates should be lower just because they should be lower, that's going to be a problem. I would expect to see the yield curve steepen. I would expect to see rates go up at the long end, not down. I think it would be counter to the administration's objectives. And I think the equity market would respond poorly to that.
Yeah, and I suspect that the argument that rates should be lower because of the cost of servicing U.S. debt, probably also not a convincing argument for the committee. Guys, thank you so much. Eric Winograd, John Hilsenrath, good to see you. Coming up, we got to check on the markets 1 hour into trading, plus some of the biggest trending tickers of the morning. We'll be right back. Nearly 1 hour into the start of trading, let's go live to the NASDAQ to get a read on the biggest factors moving markets today. Joining us now, senior reporter Brooke DePalma. Hi, Brooke.
Hi, Julie. Three things that I'm watching this morning is reaction to that CPI print that came in largely as expected, just slightly higher. In addition to that, I'm also looking at two key trade headlines. One, that we got a deal with Indonesia. In addition to that latest announcement around Nvidia. We'll get to that in just a bit. Let's take a closer look at all three major indices. We have Nvidia, the news around them being able to sell their H20 chip to China pending those licenses that they have to get, we're seeing that push the Nasdaq higher, up 0.7%. The Dow falling a bit here, down almost 0.5%, and the S&P 500 moving slightly higher. I do want to get a closer look at the semiconductor space. If you take a closer look at the YF Interactive here, we have Nvidia, we have Taiwan Semiconductor also moving higher. We have AMD and Micron all moving higher, and that's largely because the Trump administration gave the okay for Nvidia to sell those H20 chips to China. Once again, keep in mind, it still needs to acquire those licenses in order to sell the chips to China. But that's certainly making headlines this morning and moving those key stocks higher. That is then moving the Nasdaq higher. Also out this morning, President Trump going to Truth Social saying, quote, great deal for everybody, just made with Indonesia. I dealt directly with their highly respected president. Details to come. And off that, I want to take a closer look at the apparel sector. We're seeing shares of Nike, Lulu, largely muted right now, as well as if you take a closer look at VF Corp, also moving down to the downside. But those are three stocks I'm looking out for. And the reason why is because when we got those news from China as well as Vietnam, we saw those stocks move higher. Now, what we're seeing here is a largely muted reaction as investors have learned from the past, and they're waiting for those key details which President Trump said on Truth Social are yet to come. And so we'll be keeping a closer look out for those as well.
Thanks, Brooke. Now time for some of today's trending tickers. We're watching Google, BlackRock, and State Street. First up, Google committing $25 billion to build out AI data centers across the largest U.S. electrical grid, PJM. The tech giant also announcing a $3 billion deal with Brookfield Asset Management to modernize 2 hydropower plants in Pennsylvania. Brooke DePalma is still with me. And Brooke, this seems to be part of this bigger announcement that's taking place today in Pennsylvania, Carnegie Mellon, where basically it's a series of sort of public-private partnerships, right, that are fostering this build out of more data centers and the power to support those data centers.
Yeah, Google's not the first company that we heard from that's making a major investment when it comes to data centers. We just heard from Meta CEO that they're also going to invest what they said was hundreds of billions of dollars into compute to build super intelligence, saying that they have the capital from our business to do this. And this really goes to show that everybody wants in on this AI race. They want in on the ramp up of what will be and what is this artificial intelligence revolution that is currently underway. And so between Google and Meta, it's really become more pronounced that we're seeing these companies want in, they want a stake, they want to be a part of these major moves here as well.
Yeah, and we should know for viewers, we're going to be talking more about tech and the AI trade, how to invest in it with Doug Clinton from Intelligence Alpha. That's coming up in the 11 a.m. hour. But let's talk about our next trending ticker, BlackRock. Its assets under management rising to a record $12.5 trillion for the quarter ending June 30th. That's up from $10.7 trillion a year earlier. Total flows into the company's funds hitting $68 billion, $46 billion went to its investment funds. But the shares are trading lower here this morning, Brooke. BlackRock, obviously one of the biggest investment managers out here. So interesting to see it fall even as those assets climb.
Yeah, absolutely. Shares now down about 5.7% in early hours here. If you take a close look year to date, it's still up 2.3%. We've really seen this trade into technology. We've seen investors move out of banks. Perhaps that's a bit here. Also worth noting that there's optimism when it comes to just that inflow that you had noted. They said that they rose to a record of $12.53 trillion in the second quarter. And they said that that was supported by high U.S. stock prices. And once again, that's $68 billion of net client inflows. Also, some optimism when it comes to their private credit firm, HPS Investment. They acquired that. That deal closed on July 1st. Larry Fink saying, quote, these are just the early days in our next phase of even stronger growth. Investors seem to be tempered about whether or not to jump in right now.
And even though those numbers were big in terms of how much we saw in inflows, how much assets under management, apparently some of the numbers were a little bit below what some analysts had anticipated for BlackRock. But also want to get to State Street here in the financial realm. Second quarter profits there down 2.5% year over year. The bank reporting higher costs in the period. State Street costs up 11% in the quarter. The company credited those increased costs to workforce, including higher bonuses. Those shares down about 3% in today's trading. But if we've seen pretty decent performance from a lot of the financials here year to date, including State Street, which is up about 9%, Brooke.
Yeah, absolutely. What I've read so far and what sources have said within their notes is that they really are taking a key part of this, and why you see stock moving lower this morning is because that second quarter profit fell despite higher revenue, as increased costs really offset that jump in fee revenue. In addition to that, we also know that their profit fell 2.5% to $693 million. But largely, when you take a closer look, let's also take a look at JP Morgan. They also reported out today their stock roughly flat. Also take a look at Wells Fargo. Their stock is also moving lower, about 5%. And so really investors digesting what was a quite volatile quarter, as we saw Liberation Day get underway, as we saw a huge rise to record highs in the stock market. We saw all these different firms really take a bit of a different look, whether or not to raise guidance, whether or not to keep their guidance as is, and investors certainly reacting based upon that news.
Brooke, thanks a lot. And of course, you can always scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, JP Morgan, Wells Fargo, and Citi kicking off big bank earnings on Wall Street, all of them reporting better than expected second quarter results. Joining us now is David Ellison, Hennessy Funds portfolio manager, and our Yahoo Finance banking reporter, David Hollerith. David, I'll start with you. So what are some of your biggest takeaways from what we've heard so far?
Yeah, Julie, it's kind of one big takeaway, which is that compared to April, the results looked much better than feared. Across all three banks. Citigroup and JP Morgan actually raised their full year guidance for their net interest income revenue, while Wells Fargo actually pulled that back. But in general, they all showed rises in their investment banking revenue. So that was something that was back in April, kind of assumed hopes were dashed for that. And we did see momentum through the quarter. The question was really how good would the momentum be? And it seems to be pretty good at the moment. And, even CEO Jamie Dimon, who's always the contrarian, kind of came out and he did warn about the uncertainties ahead with regard to the effect of tariffs in the second half of the year, and also the potential for a slowing weakening labor market, But in general, he said the economy's been resilient. And, we heard that in spades from the other executives. So I would say generally upbeat commentary from the nation's top bankers today.
And David, let's bring David Ellison, I should say. Let's bring you into this. It was also striking to hear about sort of the better investment banking results at a lot of these banks. How important was that this quarter?
Well, I think it's been important for the last year or so because there hasn't really been much movement in the margin. Rates have come down, but not enough. The yield curve is better than it was a couple of years ago or a year ago, but not that much better from a banking perspective. So that's been a big part of the earnings growth. And I think the other side is that there really hasn't been any credit deterioration enough to really change the provisioning. So that's helped them. So I think you have an industry that, from a lending perspective,
looks like we're having a little bit of trouble with David Ellison's shot. So David Hollerith, I'm going to go back to you for a moment. I'm curious in particular, we overall, to your point, saw some more positivity from the banks. But man, Wells Fargo still seems to be having a tough time of it here, even though we saw some of the metrics beat here. But the company's net interest income, their guidance, is below what was estimated. So even though they just got the green light from the government, right, to be able to return some cash to shareholders, they're still having a tough time.
Right, yeah. And that has a lot to do with their lending volumes and their plain vanilla lending. particularly on the consumer side. And Wells Fargo has sort of talked about having opportunities of lending to non-bank financials more in the second half, and that's kind of been an area they've focused on. They're also, now that they have their asset cap or growth restriction lifted, they're trying to pivot some of their capital out of interest earning assets and into their markets business, which is a fee business. So in some ways, that could be what we're seeing here. I will say, speaking with analysts ahead of their earnings, that this was largely expected, but I think maybe it's the tepid growth so far this year that is, might be bringing down the stock at this point.
It looks like we got David Ellison back. David, what's your view on Wells Fargo?
Well, I think it's still a company trying to figure out, what it's going to be after many years of being in the penalty box. So I think everything has been, everything from a regulatory point of view is back to normal, meaning that they're like everybody else. So the question now is, how much are they going to grow? What are they going to do? Are they going to acquire things? Are they going to try to, be more competitive in the capital market business, et cetera? So, I give it the benefit of the doubt, and we'll see what happens. But I certainly would not sell it here. There's a lot of good things that they can do the next couple of years.
And David Ellison, I know that you're also watching sort of three big trends in the banking market, or drivers. What are those three trends?
Well, I think the thing, I think the whole sort of crypto, sort of trading stuff is going to be a big part of the growth. There's a lot of new products in terms of fintech products that are out there, and we see, companies coming public and providing these products. You see Hood, you see, Coinbase, et cetera. And I think the banks are going to adopt these products over time. And I think the second one is the regulatory sort of cloak or real problems have been lifted a little bit. And I think that's a good thing for the banks, because they've been in a pretty significant penalty box for a number of years. And I think the fact that they can now potentially do more transformative deals is a positive. And I think finally, which everybody talks about, is the AI and the ability to cut costs. This industry has really not benefited from any of the new technologies out there from a banking perspective. They either haven't adopted it or haven't wanted to. And I think that the companies that start to do that are really going to see cost benefits, and that's going to drive the returns higher. And I think you already see that with JP Morgan, that has a return that is, twice some of the smaller banks that are out there from a return on equity and assets perspective.
And how much of that we've seen at JP Morgan is from, sort of AI related savings and sort of execution and management inside the bank?
Well, I think it's a combination of focus. I mean, the businesses that are growing now happen to be a high return business. And I think the question now is, they have the profits to invest in the company and invest in the business. And I think that's what everybody wants. I mean, yeah, they want good returns. They want good return on assets. They want good growth in book value. But the industry, from a traditional banking perspective, there's been a lot of share lost in terms of lending, in terms of products, in terms of customers. And there's been a tremendous loss. And that's why you have Coinbase and Hood and Circle with, millions and millions of customers. Where'd they all come from? They all came from traditional banks. And the hope is, over the next, half decade or a decade, that these banks will invest in those products and earn back those customers, and therefore improve their profits and improve their growth and improve the metrics of the business. So they just got to stop losing customers. The only way you do that is to invest. And I think they're starting to do that.
I should mention, we're just seeing those JP Morgan shares turn a little bit lower here. They are, by the way, up about 20% this year, and they're trading still close to their record high, which I believe was 296. David and David, thank you guys both so much. Appreciate it. Well, speaking about crypto, we're going to have a conversation on that coming up. Stay tuned. You're watching Market Catalysts. Bitcoin is backing off its recent record high, below now just over 117,000, let's call it. The cryptocurrency, of course, surged 7% over the past week, rising above $120,000 on Monday. So is this pullback a sign the rally was short-lived, or do these new record highs have staying power? Joining me now is Andy Baer, Managing Director of CoinDesk Indices, who watches all of this very, very closely. Andy, it's great to have you here, given the action that we've been seeing lately, which has been really interesting. So there's all of this sort of fundamental enthusiasm that's going on, institutional adoption, what's happening in Congress during so-called crypto week. And then, as always, there's sort of technical effects in the market. So how do you attribute sort of each of these buckets in terms of how much they contributed?
First of all, good news. If you were worried you'd never be able to buy a Bitcoin for under 120,000, the market's giving you a second chance, so I would go ahead and take advantage of that. Bitcoin had been trading in a very, almost historically tight range ever since May 7th. The 10% range broken only a couple of times. So a lot of the trading and, as you say, technical and positioning activity had been around maintaining that range. So when it popped up above that 112,000 level late last week, a lot of the derivatives positions, especially in the crypto native market, were kind of poised for that level to keep. So there were some liquidations and short options positions, which gave Bitcoin's price that extra shunt up over the weekend above 120.
Okay, let's just linger there for
Sure.
a second just to explain that. So if I'm short Bitcoin in some way, in some market, and then it's effectively like a short squeeze that happens in the equity market and other markets. The price moves up, you have to get out of your position,
You have to cover.
which
That's
means you
right.
end up owning Bitcoin or whatever the underlying thing is.
That's right. In most Bitcoin or crypto native markets, perpetual futures is another form of futures contract. Makes it very easy for people to get long or short. They'll usually post a very limited amount of collateral. So one mechanism, which sounds terrible in traditional markets, but is not unusual in crypto native markets, is that collateral gets liquidated and the position basically gets closed out. So it happens with some regularity on the downside and on the upside. The liquidations last week were nearly at a record level, over 2 billion of perpetual futures liquidations on July 10th or so. So that helped kind of propel the price back up to its newly discovered level of around here, up about $5,000 or $6,000 more, and now we've settled back into place. So it's not really a cause for concern. I think we see these kind of overcorrections that are caused by these market effects, but still, there have been, there's $200 billion now in investable crypto-linked products in traditional space. So that's 5.5% of all of the crypto market cap. So we've gotten to some pretty interesting levels of adoption, and the inflows, especially into US Bitcoin and Ether ETFs over the last several weeks, have been notable. So the demand side seems pretty firm and not at all kind of flighty.
And not at all, the sort of number go up philosophy that was the thing really that propelled crypto for a long time. I mean, that's still there, but it feels like that
We're never going to let that go.
I mean, that's why a lot of people still buy it, because they think it is something that is going to continue to go up in perpetuity in some cases. But how important and what role is the congressional discussion around crypto having this week?
Two big things, and let's link the macro side. Although I'm more Fisher Price than Fisher Black when it comes to macro. But look, the dollar's had its weakest first 6 months of the year in many, many years. And so this idea that both gold and Bitcoin are being latched onto as stores of value is pretty credible, right? Also, you have treasury companies that hold Bitcoin and other assets becoming more popular. More people are just learning about the ETF and learning about how allocating to Bitcoin can diversify a portfolio that has many asset classes in it. So all of that is less number go up and more just kind of mainstream kind of education and adoption. We feel great about that. The rest of the market, Ether all the way down through our top, CoinDesk 20 names, which was up 16% over the last week, really feels like last November, where there was new hope for regulatory clarity, right? And so, as you mentioned, there are three big things in front of Congress this week, which we're very hopeful a lot of great work will get done, and maybe even the Genius Act gets close to being signed. That helps all the other blockchains, I think, more than it helps Bitcoin. Right, so Bitcoin is going to benefit, I think, from being top of fold, right? But Ether and the other layer ones like Sui, like Solana, they're going to benefit because there's more anointed activity on their blockchains, think stable coins, right? and then other service providers and information providers, other institutional forms of how digital assets can create ease for us in the blockchain world. All of that's been propelled. So if you look at this past week's rally outside of Bitcoin, it looks a lot like what happened last November when kind of hope got renewed.
Just really quickly, Andy, sort of what's the next price target from here? What directionally do we think is going to be happening?
I think rather than focus on a Bitcoin price target, which I think is hard, we feel that demand right now is very strong and very durable, so we think that we're safe there. What we'd like to see with better regulatory adoption is the rest of the market keep up. So keep an eye on the CoinDesk 20 index, which is very broad-based and very diversified. The CoinDesk 5 index, if you're just interested in Bitcoin and Ether and a couple of other top names, that's a good index to keep an eye on. But we think that investors will, at this new chapter, start to actually broaden their horizons for Bitcoin and look at index funds, which will help diversify them and give them access to these other names.
Thanks so much, Andy. Appreciate
Nice to see
it. You too. Coming up, details on the trade news out of the White House this morning. Stay right here. President Trump saying this morning on Truth Social that the U.S. has reached a trade deal with Indonesia. It comes days after the president sent a letter to Indonesia threatening a 32% tariff. Joining us now, Yahoo Finance Washington correspondent Ben Werschel, senior reporter Pras Subramanian, who's going to talk to us about the autos angle. Ben, let's talk Indonesia first. What do we know so far?
We don't know a lot so far, Julie. As you saw in that post, Trump ended it with an all caps, details to follow, and 3 exclamation points. But it does come, as you mentioned, after one of the most sizable threats last week from Trump, which was this 32% tariff on Indonesia, which would have fallen on our 22nd biggest trading partner, and driven by a sort of 3-to-1 deficit, nearly 3-to-1 trade deficit we have with that country. Indonesia, the negotiators were here in Washington last week, kind of following that letter and to keep talks going. They came out of that talking about a pause on that 32% tariff. But again, we don't have details on what exactly this deal entails, but it does appear to be a key breakthrough. As Trump said in the post, the talks appear to have progressed beyond those trade negotiator talks to president talks, and there now seems to be a breakthrough there with a lot of focus on industries like palm oil, clothing, manufacturers. Those are kind of the big issues between the U.S. and Indonesia. One quick warning for markets as we kind of await the word on this, whether this 32% tariff, how that's changing. We did see a similar pattern of this with Vietnam last week. Trump had a post that said details to follow, which actually saw a surge of optimism, but then when he actually released the details, which in that case was a 20% tariff on Vietnam, which has a lot of overlap with Indonesia, markets, at least footwear manufacturers, came back down. So there's a lot of details to remain to be seen here, but it does appear to be kind of essentially his fourth trade deal as he's headed to August 1st.
And also on the tariff front this morning, the European Union has finalized a list of $84 billion worth of U.S. goods that could face countermeasures if the U.S. goes forward with its plans for that 30% tariff on August 1st. So sort of readying these countermeasures. Pras, what would that mean if that happened for the likes of Boeing and U.S. automakers?
Well, of that 75 billion is industrial goods, right? So 12.8 billion in aircraft supplies and parts, machinery, another 10.3 billion, and then around 9.3 billion in autos, right? But I mean, for the Boeings of the world, look, it's going to hit the Boeings, the precision cast parts, Honeywells, Textrons of the world. Like the key U.S. suppliers for the aviation sector are going to get hit by this potential tariff. But what the EU is really worried about is that 30% tariff on goods and 25% sector tariffs that still remain on autos. And look, it's hitting Mercedes bad, it's hitting Porsche bad, hitting Volkswagen's Audi bad. Look, they're all having to take sort of hits to their sort of bottom line because of the fact they're trying to price protect from buyers, but they can't do that forever. And so the question is, can they get this deal done before the fall, where the 2026 model comes out and the new cars comes out in the U.S.?
So obviously there's a lot at stake with the EU tariffs. We're starting to hear about these other peripheral countries as well. Ben, I want to follow up with you about the Nvidia news today. This news from Nvidia that they expect that the U.S. government will start to allow them to get their licenses approved to ship some of their chips into China, the H20 chips. Is there any indication or is there any movement on talks between China and the U.S.?
Yeah. Treasury Secretary Scott Bessent had some commentary this morning on that. He did an interview on Bloomberg. His line there was that this Nvidia chip, he confirmed that Nvidia chips were part of those conversations. He called it a bargaining chip to a pun between the U.S. and China on these larger trade talks, which encompass a lot more issues like rare earth minerals, to get this Nvidia piece done. Bessent also confirmed that China talks are continuing. The key deadline to watch there is August 12th, which is when that 90-day pause runs out. What Bessent said is that they're trying to have another meeting either before or after a larger China gathering at the beginning of August to do that. His overall message is that markets shouldn't be too worried about this August 12th deadline, but that is the looming deadline when much bigger tariffs could come back on if those talks go sideways.
Lots of continued things to mark on our calendars. Ben, Pross, thanks a lot, guys. Coming up, full market coverage ahead in the second hour of Market Catalyst, including a deep dive into AI investments. Don't go anywhere. Coming up this hour on Market Catalyst. First up, U.S. stocks hitting record highs as tech continues to lift the major averages. We'll have full market coverage ahead. Plus, Nvidia and AMD rising as the U.S. eases curbs on chip sales to China. Details to come in today's Investor Playbook. And we'll bring you the takeaways from Bank of America's latest fund manager survey. Sentiment rising to pre-tariff levels. All that and more coming up on Market Catalyst. Well, 90 minutes into the start of U.S. trading, I'm Julie Hyman, and let's get a check of the market. So what we see here, the S&P 500 actually touched a record high, was set to close at that level, but now we are seeing it pull back a little bit. The NASDAQ, it looks like, still might get to that level, both of them touching intraday records. The Dow, though, is down by about 313 points. A lot of cross currents today. We, of course, have had banks reporting and sort of mixed reaction to those numbers. On the flip side, we have Nvidia, as we mentioned, rising after it got, or it looks like it's going to get the green light from the U.S. to send some of its chips back into the Chinese market. And then don't forget CPI, which we got this morning. Also, core CPI coming in a little bit better than had been anticipated by economists. So let's bring it to the bond market then. On that note, we are not seeing huge movement here, but we had been seeing yields move lower earlier in the session. Now we're seeing them move a little higher, interestingly enough. The 10-year yield up by 5 basis points of 4.47% right now. Well, at the halfway mark of 2025, IPOs on U.S. exchanges have raised nearly $30 billion. That's a 45% jump from last year, according to Bloomberg data. Two of the year's largest U.S. IPOs, Circle and CoreWeave, are up triple digits since their debuts. So what can we expect in the second half of the year to bring for public markets? Joining me now, Brianne Lynch, head of market insight at EquityZen, which is a pre-IPO investment platform. So you guys have a really good insight and eye on all of those pre-IPO companies. Thanks for being here.
Thanks for having me.
So we mentioned that exits are up 45%, but let's be clear, it's from a very low base, right? It's still not been a busy market, I guess, for IPOs. What is still sort of holding things back in your view?
Sure. So to your point, we're certainly not at those 2021 highs where the IPO market was booming, but we are seeing an increase in activity, against all odds. We saw the market really pull back when it came to IPOs in April, post-Liberation Day. There was a lot more concern in the market. But in June, several companies decided to kind of rip the Band-Aid and go public. So we saw Hinge Health, Mountain, Circle, Chime, many others go public and perform well. So that's really given a vote of confidence for others to follow. So we see the pipeline starting to build and probably expect to see more activity in the fall.
I'm curious, over these past several years, as we have seen the number of companies coming public go down, what is the interest level on EquityZen been? Has that been consistent? Has that sort of waxed and waned? What have you seen?
We've seen a big uptick in investor activity in the pre-IPO market because there's been this drought of IPOs. So investors don't want to wait another year, 2 years, 5 years to invest in these companies that are growing so rapidly in the private markets. You've got, companies in AI, fintech, crypto, some of these top in-demand industries all growing to tens of billions, even hundreds of $billion valuations in the private market. So we've seen a big uptick in investor interest, over 40% in June alone, driven by investor interest in getting these names earlier.
And on your platform, people who are accredited investors can get into some of these companies, right?
That's right.
Okay, gotcha. So let's talk about some of the companies that have come public that you've alluded to, right? Circle, and I mentioned CoreWeave as well, which have just been, have really seen big increases. Is it, I don't want to use the word bubble, but is there froth here with some of these new IPOs?
What we've seen, let's talk about Circle, for example. There's just a lot of momentum and a lot of catalysts when it comes to crypto specifically that have really enabled that stock to fly. You've got a crypto-friendly administration in place. It's DC Crypto Week, more legislation's being reviewed there. Stablecoin legislation has already passed. Bitcoin is trading near all-time highs. Coinbase, which was the first crypto IPO back in 2021, is now an S&P 500 company. So all of these pieces really played together to create a lot of validation in the market, which allowed Circle to really kind of go public at this opportune time. We've seen in the private markets that crypto companies are growing in popularity. It's the number 6 most popular industry amongst investors. So when you look at Gemini and Grayscale and others, they're seeing the success that Circle had. And yes, they're different businesses, but also trying to, take advantage of that opportunity.
Right, exactly. And we got that S1 filing from Grayscale yesterday, that confidential filing that they're planning to go public. They say it might not happen, but it's, they've at least put the filing in. So what do you think is driving? And that was not one that was sort of chattered about, right?
No, this certainly wasn't one on our 2025 IPO outlook list, but they are really trying to capitalize on the interest there is for crypto companies as a crypto asset manager. They were one of the leaders in creating these investable products like crypto ETFs, and fast forward a few years, you have BlackRock and some of the largest asset managers playing in that same space. So it's certainly become more competitive, but I think they're looking to take advantage of investor interest while the market is hot.
On your platform, what are some of the most popular individual companies?
Sure. So the most popular companies we're seeing are kind of like the who's list of the private markets. You have SpaceX, Anduril, OpenAI, Perplexity, companies that are valued at tens or hundreds of billion-dollar valuations that really don't have plans to go public anytime soon. So that's why we see more investors coming to the pre-IPO market to invest while these companies are in such rapid phases of growth.
And is that interest pretty consistent for some of those companies?
Yeah, some of the companies, certainly that top 5 have been some of the most popular over the past several quarters. Defense tech is an industry that has grown in popularity. So Anduril, Helsing, and some of those other names have grown in popularity in the past 2 quarters versus AI companies that have kind of led the market for the past 2 years. So it's certainly not a static story where new innovative technologies and industries kind of come to market and change the landscape.
And lastly, do you expect to see any kind of pickup in IPO activity? And what's the thing that would unlock it? Would it be a rate cut, for example?
Sure. It seems like a lot of these companies that are in the pipeline preparing to go have accepted that there's going to be some volatility in the market. So we don't know when a rate cut would happen. There's still a lot of uncertainty around tariffs and inflation. But the companies in the pipeline, like Klarna, like Navan, have been looking to go public for a very long time. Mm-hmm. These are, big companies with large brands and market presences already. So many of them are choosing to bite the bullet and do that. Summer tends to be a slower period, so it's probably the fall that we're expecting these IPOs to happen. But that pipeline is already there, and we expect to see more activity then.
Brianne, good to see you. Thanks for coming in. Appreciate it. We got much more markets action coming up, including that deep dive into AI investing. You're watching Market Catalysts.
Metal futures have made some pretty dramatic moves lately, from safe haven gold to tariff-sensitive copper. So let's take a look at the longer-term trends. I'm Jared Blickery, host of Stocks in Translation. And I'm going to start by charting some of the moves in Dr. Copper, because this is where we have the most zigs and zags over the last 25 years. So this goes back to the beginning of the century, and we can see right now we're at $5.51 per pound. That is a record high. But if we go back to the beginning of the century, guess what? We had a little bit of a slump in the wake of the dot-com boom and then bust, but starting in 2003, we saw a big rise there, and that was as China actually joined the World Trade Organization, or the WTO. That lasted into the global financial crisis. Then we had a pretty big bust in Dr. Copper, and then we had another rise, and that rise was due to unprecedented stimulus, not only from the Chinese government, but also from the United States government. QE was in force, and then we saw kind of a strong dollar play. That weighed on this metal all the way into the beginning of 2016. The entire world, most of the world indices went through a bear market in 2015, and then 2016 we found the footing. And that was actually the year that Trump began his first presidency. And from there we saw some zigs and zags, and then we saw a shock into the pandemic. A couple of years of deflation or semi-deflation, disinflation, that caught up with it in 2022, but then it was off to the races again, and especially with the Trump tariffs now on copper threatening to be 50% on August 1st, we're seeing a lot of front running in this trade. Now, I also want to show you gold futures, and I'm going to show you silver as well, and they follow a very similar pattern. We're not seeing the dramatic zigs and zags that we did in copper, but we did see the same pattern of China joining the WTO, contributing to that huge rise in price to $1,800, almost $2,000 an ounce by the beginning of the global financial crisis. Saw a little bit of a meltdown there, but in 2016 into 2018, we saw a bit of a rise into the pandemic, a little bit of a whipsaw there, and consolidation over a few years. Again, that 2022 bear market in US stocks, that contributed to some deflation and disinflation globally. Supply chain shocks came into force again, and then we saw this huge rise beginning in late 2023, and we are now at $33.53. We've seen a high of as much as $3,500 per ounce. And gold is kind of unique among the precious metals and also the industrial metals, and this is because central banks have been a huge determining force in their buying of it. This is a bar chart that shows central bank buying in tons going back all the way to 2010. And what you notice here is the last 3 years, 2022, 2023, 2024, all of those had gold being bought by central banks in the amount of over 1,000 tons. And so that's a pretty big dramatic increase from the prior years. And this has to do with the ongoing de-dollarization in China as well as Russia, but also a host of other countries, even some in Western and Eastern Europe. So this is a trend that we want to follow. I want to close out here with silver, and I'm going to just chart the price action. Again, very similar chart to gold and copper in terms of the big movements here. We saw a big price spike into almost $50 per ounce, and that was just as the global financial crisis was getting underway, and then the QE area in 2011. That's when we saw that high. Then we saw a dramatic crash into 2016, kind of found its footing, saw a big squeeze in the early pandemic. 2020 was a great year for silver, but then we saw a little bit of a fallout. And again, silver is on the rise here at $38. It's still off of that $50 record high, but it is increasing very quickly. To round out the conversation, I want to just present a table here. I have all three metals, and just kind of grouping them together, I want to display how they are moving with their specific patterns, with a trigger, and then to tell you which one of these is featured in these specific criteria. So here, under the pattern, we have acceleration. So that would be an economic acceleration. The trigger would be liquidity. And when that happens, we see all metals benefiting from that. And then when there's a safe haven scare, and that trigger would be a crisis of some sorts, you're going to see gold and silver outperforming the most, kind of leaving Dr. Copper behind. And then here's a bearish one. Industrial drags, that affects copper disproportionately here, and the trigger there is typically a stronger US dollar, because the US dollar surges when global industrials tend to drag, and that's because the U.S. is the least dirty shirt in the laundry basket of the world. And then finally here, we have a policy shock. This will affect all three metals, but especially copper and gold here. Arguably, the biggest reason is tariffs and debt, and we've seen both of those contribute to silver rising, so we could put all three in that basket as well. But when you put it all together, we have the perfect explosive mix for all three of these metals, including palladium and also platinum, which we didn't have time for. But all of these are experiencing huge thrusts in 2025, and we'll have to see how these tariffs play out, especially on Dr. Copper with respect to that August 1st deadline. Remember, 50% there. So tune into Stocks in Translation for more jargon-busting deep dives. New episodes on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
Jared, thank you. We got much more markets action coming up. Stay tuned. You're watching Market Catalysts. Nearly 2 hours into the start of trading, let's go live to the NASDAQ to get a read on what is moving markets today. Joining us now, senior reporter Brooke DePalma. What are we seeing, Brooke?
Good morning, Julie. Well, if you're just joining us right now, stocks are largely muted after that key CPI, Consumer Price Index, that came in largely as expected out this morning from the Bureau of Labor Statistics. As we saw those tariffs rolled through, we saw the CPI report increase 2.7%, a little bit more than what economists had expected, around 2.6%. Now, of course, as we typically do, we heard from President Trump on Truth Social, who said, quote, "Consumer prices low, bring down the Fed rate now." Now, markets largely expect the central bank to hold steady, and we see a pretty much muted reaction out this morning based upon those reports. One key area that I do want to watch is this NASDAQ. What we've seen over the past few months is the NASDAQ rise to those record highs, and we see them holding on to that momentum right now in early hours of trading. And what's largely leading that, once again, lead to record highs is Nvidia here. And what we know there is the Trump administration gave the okay to Nvidia to sell those key H20 chips to China. Now, keep in mind, Nvidia still needs to get those licenses in order to sell those chips to China. But what we're seeing is Taiwan Semiconductor, TSM, also rising. We also see Micron up slightly, and AMD seeing a big move here, up 6% in early hours trading here. Those will be something I'll be watching as we make way into the trading session.
Time for some of today's trending tickers. We are watching Tesla, Joby Aviation, and Uber. First up, Tesla seeing another high-level departure, according to the Wall Street Journal. The company's top sales executive for North America has left the company after spending the last 15 years there. Troy Jones' departure coming as Tesla faces a steep drop in sales amid Elon Musk's prominent role in the White House. Brooke DePalma still here. And Brooke, we've seen a number of departures from Tesla this year as we have seen those sales drop and Elon Musk's attentions be divided.
Yeah, Julie, a number of departures, including the top aide to CEO Elon Musk, who was promoted less than a year ago and then ultimately left the company as well. We also know that the company's director of human resources had departed back in June. And if you take a look at Tesla's stock price, what we've seen over the past year is the company down more than 30%, 34% from a record high close back in December of 2024, specifically December 17th, when the company's stock hit $479.86. Of course, that was right after the election. There was lots of momentum for Tesla as well as the larger EV space. And now we're seeing the stock trade at $314, down significantly from that record close as investors really try to digest all these executives leaving, as well as where Elon Musk stands now and where Tesla sales certainly are.
Yeah, definitely a lot of questions about what is next for that company. Coming up next, we've got air taxi maker Joby. It's doubling its main plant's output capacity. The move coming just weeks after completing its piloted test flights in Dubai. The expansion will enable the facility to build up to 24 aircraft per year. That's according to a company statement. Joby shares today up 7%. They're up this year. I remember this company was a de-SPAC. I don't know if you remember, Brooke, but it was one of these companies that came public through a special purpose acquisition company. Exactly, like 2020, 2021, I think is when it was completed. And so it's trading like, what, $3 above that $10 start price.
Yeah, believe it or not, Julie, what I'm seeing here is 1366. That was actually a 52-week high for the company. Of course, now shares pulling back about 10 cents. Now the stock is at $13.54, 55 cents. And what we're really looking at here is, once again, this was part of a SPAC merger. There is not too much coverage on the street. It hasn't largely been adopted by the street. Only 9 analysts cover the stock. And right now, ratings are 3 buys, 4 holds, and 2 sells. In addition to that, I know that you noted, but all eyes are also on the launch of commercial operations in Dubai as early as 2026. And there's some hesitation there. In a JP Morgan note out recently, they said they have incremental confidence around the probability of a successful launch last year, but they ultimately expect low volume based upon that launch. As potential customers, well, they have to see how it goes before they jump in and take a ride as well.
And finally, let's talk about Uber and China's Baidu. They're teaming up. The companies plan to launch robotaxis on the ride-sharing platform in several markets outside of the U.S. and mainland China through a multi-year partnership. Baidu's autonomous vehicles will be available on the Uber app in Asia and the Middle East later this year. Uber shares pulling back a little bit today. Baidu shares getting a big lift of about 8%. And this sort of continuing, Brooke, with Uber's strategy of partnering with others when it comes to sort of autonomous driving, not owning, the sort of asset light model, if you will.
Yeah, the CEO saying this morning that Uber is uniquely positioned to help EV leaders like Baidu bring their autonomous technology to the world. So not necessarily doing it in-house, but really relying on these key partners in order to make this happen. I mean, Julie, I still have yet to see, beyond Google's Waymo when Phoenix, Arizona, I've yet to see all these different players come to fruition. But it's interesting to see Uber continually outsource. Of course, Tesla got a bit of a rise in the stock in the last month, in late June, after they rolled out their autonomous vehicles and tested it with key influencers. That got a bit of a rally there from investors. But it's interesting to see them sort of push out the business as far as Ubers go, rely on other partners. Of course, Baidu, they team up with, I think, something like 15,000 cities that they're in. And so it'll be interesting to see the way that this all plays out. Of course, Uber looking to really grow their presence here, not only as what many know them as the car, vehicle, whatever you want to call it, renting to jump in and haul a ride haul service, but also Uber Eats they have, and now they're looking not to fall behind with this autonomous vehicle race as well.
Yeah, exactly. Thanks so much, Brooke. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, tech is lifting the broader markets today. Nvidia's rally sending the S&P 500 and NASDAQ to fresh intraday highs. Joining me now is Doug Clinton, Intelligent Alpha founder and CEO. Doug, it's so interesting because we have this going on, and at the same time, there's this big event expected in Pennsylvania. We've been getting little trickles of announcements out that various companies, including Google, are going to be spending more money on data centers and on power investments for those data centers. So when I want to get like a sort of a temperature check on the AI trade, I think of you. Kind of where are we in the cycle right now, and how should investors be thinking about it?
I would say the temperature is probably a little bit elevated right now, Julie. I mean, you think about AI over the last 2 years, it's felt like this sort of nonstop train where we've had increasingly impressive model releases from the large model building companies. We've had, to your point today, energy investments, companies building gigawatt investments in energy. Meta, as an example, right? Microsoft, Amazon, all of them are trying to make sure they have enough power for their systems and their chips. And so I think that we're going to continue to hear a lot of news about AI over the next 3 to 5 years. We still think we're in the midst of a 3 to 5 year bull market for the AI trade. To your question about temperature, though, I think if you think about that long term, think about 3 to 5 years, and we think AI has this kind of up and to the right trajectory. Along that trajectory, you will have times where you sort of undulate above and below that long-term trajectory. I think we're probably above that right now. So we are heated. We've had a lot of AI stocks up 100+% in the last few months. And so maybe it's time for things to cool down a little bit, but don't miss that long-term trade. That's the way that we're approaching it.
So I guess it depends on what your investment horizon is, right? If you're looking over the longer term, maybe there's still room for you to get in. And you guys, you use fundamental analysis, but you also use AI analysis to help you choose stocks. So I know AMD is one of those that you're looking at. And in addition to Nvidia getting the go-ahead or expected to get the go-ahead to reship into China, AMD has said it expects to get a similar approval. Is that a potential catalyst here, or what are you looking for big picture?
It is a catalyst for AMD. And I think AMD, it's funny, the story has always been for the last year plus that everybody who is building these data centers, they want an alternative to Nvidia. We just want diversification in the supply chain. And AMD has always been the best bet to be a second option. Their chips haven't really delivered. There hasn't been as much demand, I think, as people had hoped for them. And actually, that story hasn't changed, but we've kind of come back. It feels like the stock sort of got washed out. All of the optimism that I think there was that they would really become this second player last year is gone. And now the story, it's kind of come back a little bit, where they just announced their MI400 chip. Sam Altman was on stage at that announcement. And so they are trying to push some of these bigger partnerships. And I think it's one of those stocks where if they can get some momentum in their fundamental business, then this is one that could have maybe better longer term upside. Think about it, 6 to 12 months than Nvidia, because it's not valued the same way.
Let's talk about another one that we don't tend to talk about as much. I believe it got an analyst upgrade today. That's GitLab, which is sort of in the development ops, right? What exactly, first of all, I guess, what exactly does GitLab do, and how does it fit into this whole thesis?
GitLab does, that's right. DevSecOps is kind of the industry term, but the way you can think about it is they're sort of a direct competitor to GitHub, Microsoft's company that they acquired several years ago, that just helps coders basically manage their code bases, collaborate on developments that they're building. The thing that GitLab, I think, is trying to do to separate themselves a little bit from GitHub and some of these other coding assistants we're seeing, like Cursor, for example, $9 billion private company, is they're really focusing on the security angle that they have built into their software and built into their platform. And again, I think like in AMD, which we actually own both of these stocks in our long-short hedge fund at Intelligent Alpha, like AMD, if they can start to get a little bit of traction with their customers here, I don't think there's a lot priced into the stock, and I think that could move things higher.
Marvell, is another one that you guys are looking at here. And, this is also one that has been bid up, certainly, and that people have been looking for around this AI thesis. But what do you think is next here?
What Marvell really needs to do is answer this nagging question that they've had about Amazon as a customer. It feels like it's sort of a never-ending story about whether Amazon is going to continue to really build products with Marvell or not. And I think that's really the overhang on the stock. If we can kind of get some clarity on that situation, it doesn't feel like a positive outcome is priced in here. But I do think there's going to be a ton of demand, going back to this idea of a second source of chips, right? AMD for the general purpose GPU, that's the best solution. Companies like Marvell and Broadcom, what they actually help companies like Amazon, as an example, do is develop their own custom silicon. I think there's going to be a continued large demand for that custom silicon. Marvell is the second place player to Broadcom in that space, but I think they could have a tailwind there if they could get some new customers. That would be incredible for the stock.
Another stock I wanted to ask you about, Doug, is Meta, because sort of more visibly and publicly than any of the other AI players at the moment, it has been throwing money out there, right? It's been throwing money at talent. It's been throwing money at CapEx. What do you make of that move, and is that a good or even necessary investment for a company like Meta?
Mark Zuckerberg he's the ultimate wartime CEO. When he sees an opportunity, I think he attacks it really like no one else. And to your point, I mean, they've probably spent several $billion, or at least allocated several $billion in just the last month or two to high-end AI talent. Because I think what Mark Zuckerberg was seeing was that their model Llama was hopelessly really trailing at this point the competitive products from OpenAI, from Anthropic, from Google, from xAI, and he just needed to take a shot to try to get back into the race, and that's exactly what he's doing. It's funny from a company perspective. I actually think Meta has done better deploying AI internally than maybe any other company. They do a great job, I think, building ad products that are powered by AI to help their customers get better results and spend more money on the platform. But as a model builder, they've been woefully last place, in my opinion. And so if they can get something going in the right direction there, that might be good for the stock. It hasn't been a conviction pick in our AI models more recently, but I think it's definitely worth watching.
It's so interesting that you frame it as him being a wartime CEO, right? This sort of idea that we're in an AI war right now amongst these companies. Do you think that there are going to be clear winners and losers, or do you think that ultimately the market's going to be big enough that there will be a piece for all the players? I mean, what are the stakes here?
I think there's always winners and losers in these huge, sort of world-changing markets, which I really do believe that AI is. I think that ultimately you probably have space for something on the order of 2 to 4 really competent foundation model providers, right? And maybe 2 or 3 infrastructure providers. And so everybody is trying to get their seat at the table for those winnings. I think that ultimately, if you think about, say, the consumer AI opportunity, sort of a personalized AI, I think you could have well over $1 trillion a year sort of revenue opportunity out there where customers are paying, whether it's 20 to 50, maybe even more dollars per month to have an AI that can really act as a personal assistant, a true personal assistant that's useful, that really gets things done on your behalf. So I think that's a huge market. And we have OpenAI, we have Google, I think we have Meta probably thinking about that game to some extent. So the stakes are very high, but I think there will only be a narrow, low number of winners.
How far away are we from maybe seeing that kind of future?
I think we're starting to see the inklings of it now. What we've had over the last 2-ish years has been sort of the emergence and the evolution of these models from something that was like, hey, this is really cool, you can chat with an AI model, to now they're actually capable of doing things like writing code. It's hard to get them to do it, but they can do things like buy airline tickets, they can order DoorDash, right? So it's kind of there if you really want to do the hard work to get it to work. I think for the average
Nobody wants to do the hard work to get it to work. That defeats the purpose, Doug.
That's Julie, that's the $1 trillion opportunity, is can one of these companies make it easy?
Right.
And I think that we're probably 6 to 12 months away from really seeing that kind of easy button where you can just go and it just works for you.
Doug, great to see you. Thanks for joining us.
Thanks, Julie.
We got more markets action coming up. Stay tuned. You're watching Market Catalysts. Apple has lagged its Magnificent Seven cohorts as it falls behind in the AI arms race, and iPhone sales slow. Asking for a Trend host, Josh Lipton spoke to Corey Johnson, Capital Research Chief Market Strategist and host of the Drill Down podcast, about Apple's AI strategy. Let's listen in.
You and I have both been at this for a minute covering Apple. It is true that Apple never does these giant deals. It is also true that the analysts constantly are begging Apple to do giant deals. Some of those analysts working in investment banking firms that would like to suggest everyone should do lots of big deals because they take cuts of them. Apple doesn't do big deals. Now, maybe that'll change. Things have changed over the history of Apple. But I think it's just not the way this company does business. But the constant calls them to do these things, they happen to follow a cycle, and it usually is right before some major innovation or big uptake in Apple product consumption.
I'll give you a name here. I had Dan Ives from Wedbush just on the show, and he said not only do they need to do a deal, he gave me the name. He said they need to buy Perplexity. That's what they need to buy. I think his exact words were, that would be a no-brainer, I believe is how he put it. Would that be a no-brainer, Corey?
I think, Perplexity is losing vast fortunes. We don't know the numbers because it's a private company as they try to build out their AI models. They also have a lot of people in-house. One of the things about acquiring an AI company right now, we certainly see it from the headlines from, in particular, Mark Zuckerberg taking over hiring at Meta, is that the assets walk out the door every day. You might have a great large language model all cooked up, but the ability to evolve upon that is really those hard to come by AI engineers, and those engineers getting offers which are kind of hard to believe, but 100 million, 200 million, Juan Soto kind of numbers. those may be true. Those may be related to weird compensation involving stock options and over time. But I think that the notion that you would go out and buy a company and own the assets isn't what really happens here. What happens is the assets are sitting in a chair and can take the elevator out and be gone the next day. So it's a trickier thing in this era as this industry evolves. And I think that that's the point, right, is that Apple has never been first to the game. You could argue maybe back in the 70s when they invented some of the first personal computers, then they were first to the game. But Apple has typically not been first to the game in the products that they release. They wait for the pioneers to take the arrows, and then they create just a better product. And we've seen that time and again from Apple.
How would you generally characterize, Corey, Apple's AI approach, Apple's AI strategy, and how you see it differing than a lot of the other tech giants we talk so much about?
Well, I think it's really important that it follows a lot of the things that they do from a product basis, whether it's software or hardware, that they are very focused on user privacy, and they're very focused with the things happening on the device, which is how they make their money, is selling devices. Yes, services are an increasing component of their revenue. But I think that going forward, what we're going to see from Apple is they're going to start to incorporate pieces of AI into these devices. They're not willing to have the problems that OpenAI, that ChatGPT is given with hallucinations or Claude or Gemini. They want to have a higher quality product. I think they've been burned by some of the errors we've seen from Siri, and yet the Siri errors are nowhere near as bad as the results that have come out of ChatGPT or Gemini or even Claude over the course of the last couple of years. And I think that what they want to have are some in-app or on-device AI processing that's happening, and the chips are just getting there. And what that's going to mean is a real big turnover in phones that won't be able to do things that most of the phones in the market, the new phones in the market, will be able to do. And it's going to create some real sort of device envy among their users with the new iPhones coming out this fall, and indeed the phones coming out next year and the year after that. They're going to start to look really different. They're actually going to physically look very different. We're going to have a foldable iPhone as well. But the notion that you can do certain things in AI with a newer iPhone that you can't with an old iPhone could really create a new driver of demand for their physical devices.
What is your sense, Corey, of how excited consumers are for these AI features? I know investors are excited, and I know many on the street are excited. What is your sense of how excited our friends and family are? You mentioned those new iPhones. You'd expect Tim Cook to take the stage somewhere, in September. He'll unveil the new iPhones. I mean, is your sense a lot of folks will upgrade or not upgrade based on the AI features, or will it be about the processor and the battery and the camera? What do you think?
I think that the AI use cases aren't there right now. When the first iPhones came out, even before there was location-based services, we couldn't imagine that there would be multi-billion-dollar companies created with things like Instagram or Uber, and those things became possible largely because of the iPhone and other phones as well. And so I think that the ultimate use cases of AI, you watch people try to use AI like it's a search engine. And those are not the true sort of amazing things that AI can do here. But I think that Apple might quite well be the leader in showing us actual functional use cases for the average person to put AI to use. And that's just not there yet.
They're telling me I have to go, Corey, but I need one more Corey Johnson hot take. Tim Cook, you saw how there was some real hot talk about Cook, and analysts had raised this question, Corey, about whether it was time to make a big change in the C-suite there in Cupertino. We should know Bloomberg's Mark Gurman reporting Cook is staying put, he says, but I'm just curious what you made of that.
Well, first of all, I know not to cross Mark Gurman when it comes to covering Apple, but
yes.
I wrote a note a couple weeks ago, the headline of which was Tim Cooked. But I think that, over time, we're starting to see some big changes in the leadership of Apple, whether it's Tim Cook or not. One of his chief deputies announcing his retirement, I think last week, the COO, who's been so responsible for the success of Apple over the course of the last 20 years. Apple has not had the kind of mistakes we've seen from every other technology company ever, which is buildup of inventory when consumer demand or economies change. Apple has kept that from happening because they've had such great control over the manufacturing process. But we're going to start to see some of these real senior leaders are just aging up at Apple, and we'll surely move on to some new leadership. We will see those changes, whether it's Tim Cook leading the way out the door or not.
Market sentiment is the most bullish it's been since February, with investors increasingly pricing out the risk of a recession. That's according to Bank of America's latest fund managers survey. What's behind that bet? Here to break it down, markets reporter Josh Schaefer. We watched this survey closely. It has lots of good nuggets and tidbits in there.
Yeah.
So how is this being reflected?
Yeah, Julie. So, I mean, one of my favorite charts as we do look at this sort of every month looks at the investors expecting a soft landing, a hard landing, or a no landing for the global economy in the next 12 months. So soft landing is sort of that ideal where inflation falls to around the Fed's 2% target. We don't get a recession, ideal outcome, right? Hard landing would probably include a recession. No landing is maybe some sort of stagflation scenario where inflation doesn't quite come down, but growth picks up. And what we saw in this month's survey, which was rather interesting, no landing picked up to about 21% of survey respondents, highlighting that. Soft landing sits at 65%. So soft landing on your screen right now is in purple. Soft landing remains sort of the base case, right? But the important thing here, I think, is that hard landing, that light blue, light green line, the little small one at the top now, is continuing to shrink, right? And so I think that's really what you've seen over the past 2 months in this market when we talk about how economic data is relating to the market rally. There's just fading risks of recession. We were talking a lot about it in April, some about it in May. Economists I speak with now aren't really talking about it at all, right? And so I think that's been kind of the macro shift that we've seen that sort of backed this rally. Now, I would note the number one risk. Guess what the number one risk is that investors see?
Tell me.
It's trade policy, right?
Yeah.
And so it's still trade policy and it's still recession. And so I guess that sort of tells me that A, of course, that's the number one risk right now, right? But B, also, it's not something that traders have maybe fully discounted, maybe something people are starting to.
Well, they're not really reacting to it. Even if they say it's the biggest risk, they're not pricing it in as a big risk.
No, I mean, you have the NASDAQ, I believe, trading at a record high right now.
Yeah, the S&P touched one today, too.
Right, so you're still sitting close to record. So that's definitely not, it's a risk, but it's not something that seems to be holding this market back right now. And I think what you're just continuing to see people flow into the market, right? I mean, sentiment is at its highest level since February, but Michael Hart and I pointed out within that note, Bank of America strategist, it's not at the level that we saw back in November, which is kind of interesting in the post-Trump excitement.
Right, even though stocks are higher.
Stocks are higher, but sentiment has not come all the way back, which if you talk to some strategists, our friend Ryan Dietrich was pointing this out on X today, does that mean the rally has more room to run as more people want to join? I mean, anyone's guess, right? Yeah. But it is an argument that you could hear someone that's more bullish sort of make, is not everyone is in this party yet.
What about what is leading, right? The market seemed to be broadening out. The rally seemed to be broadening out, but now it seems to be narrowing again.
Yeah, we were talking a lot about this over the past 24 hours, right? It's sort of like a tech and everyone else trade. And Kevin Gordon over at Charles Schwab was pointing out, I think there's over 400 members of the S&P 500 that are currently down today, which means that essentially less than 20% of the index is up. I mean, if we looked at just simply the sector action, it's just tech. That is the only thing that is up today. Tech is leading, and it's almost holding the S&P in positive territory, depending on what moment you look at it.
Yeah.
And so it's definitely become a lot more of a narrow rally, at least for now. The question is, what does that actually mean moving forward, right? You could, again, you hear both arguments from that.
Yeah.
It's, oh no, it's just tech leading, or maybe it's just tech leading and that's a good thing because those are strong companies.
That's enough.
And
We've seen it work so far.
Yeah, it's worked for 2 years, right? To some extent, so yeah.
We'll see, as always. That's what we're here for. We're here to watch.
Well, we'll check it out tomorrow, Julie. Market Sunrise. Be there.
Well, I will. Yes, that's right. Watch Josh on Market Sunrise tomorrow morning, 7 a.m. New York time. That's it for Market Catalyst. In the meantime, I'm Julie Hyman. Thanks for watching. We've got more Yahoo Finance coming up.